Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with 173 SME IPOs this year raising nearly 6,000 crore rupees, 2024 has been a blockbuster year for them. And the appeal is quite clear. Who wouldn't want to invest in a company early on, ride the wave of growth, and then pocket big gains? But behind this facade lies significant risk. And we'll talk about that with Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, let's begin with, SME IPO Index. The numbers so far has been really good. It has been the best performing index. Why the investors need to be cautious about it?
One is that these are tiny companies. The very design of a SME listing is that the paid up capital should not exceed more than 25 crore. Of course, there could be premium and other things, so there could be a larger size issue. But the paid up capital is 25 crore. If you look at the universe of the companies listed on the SME segment, it has just gone ballistic. It has not gone ballistic on relative terms. It has gone ballistic extraordinarily as compared to the other options available. When you look at the small cap index or the mid cap index or Sensex, Nifty or anything, they are up 15, 18, 20% over the last 10, 12 years, which will be considered a handsome return. Here is an index which is just made up of 8, 10 companies in the SME companies. Its annualized return is 61% annualized over the last 10 years, which means that you invested 100 rupee, it went up to 160 rupee. Then 160 rupee earned 60% more. So 61% annualized year after year over the last 10 years. So it has been extraordinarily rewarding. Even last year, last trailing 12 months, if you look at last 1 year, this thing is up 191%. You have trebled your money. So this is something which looks, eye-popping. It looks very difficult to ignore. And when you have such extraordinary return, it hides all the risk because you can well afford to ignore the risk. The real risk lies in the vulnerability of a small company. One downturn, it'll be over. They will not be able to withstand. Small companies are more vulnerable. Second is that, there is a likely risk because the regulatory oversight in these companies, the small companies, it is on the assumption that the disclosure norms that disclose this, comply with these laws, and that's fine. And the supply is very short, small. So if there is a little bit of a speculative interest, they simply shoot up. But there is also as much a possibility that if a fraudster or if a not so high quality promoter wants to raise money on the SME exchange, and to the tune of, by making up, you still can make up books, you can still pretend to be doing well. And if you're able to sell your stock, investors will be in for a surprise. And that is where I think, that is where the regulatory red flag came about. Right. They are going about review of this. Things look too good to be true, and they're a little bit unreal. And there is a risk. These companies can disappear. So can any company. But these companies if they want a bigger risk, they are not, not much is known about these companies before they go public. Right. They're tiny companies. So, your money is more vulnerable. When you have, this kind of thing going on, successively for the last 5-7 years, it is normal to be very cautious.
Okay, so that's why investors need to be careful. But do mutual funds also invest in SME IPOs?
Not much, because for mutual fund, it's not worth their while. Even a small cap fund today is a 10,000 crore fund. Here's a company which is so tiny that even if they acquire, something like 10% of a company, it will not be meaningful. So for mutual funds to be investing in small cap, they have a large universe to invest. Right. But these small companies are even underneath that. They are below the radar. So it just does not make, I think one mutual fund has invested in few of these companies. In fact, one company and couple of funds. So it's virtually insignificant.
All right. What are the potential red flags if one wants to, take a plunge and, invest in SME IPOs? What are the red flags that one should look out for?
There are two ways of looking at it. One is that don't look for red flags. invest in every SME IPO. Keep doing it. Just make sure that you get the allotment, ride the boom, sell it. That is called stagging. You invest in an IPO, but that could be a dangerous thing because at one point you might get stuck. The second one is a long one, where you can succeed with SME in a more confident way, which is you will have to get into the stock analysis. I think if I have to frame 3-4 rules about any company before you invest, you must check before you invest, which is, the company should have a positive cash flow. Make sure that the company has a positive cash flow and the receivables is not more than, the payables. Because, that is many a times companies are able to make up the numbers in a manner where the money may not come in the company, and you might be looking at the earning per share and the growth and all that, but nothing will happen.
So is there a way to
Yeah, there's a way to do it. The way to do it is go to Value Research Online, look at that company's page, and you will get all these numbers at the outset, on the dashboard of that company itself, and you will see that what is the quality of that company, what is the quality of earnings, what is the momentum of this company, what is the valuation of this company. So if you can look at growth, momentum, quality, and valuation, I think you are unlikely to do a blunder. And the only thing you have to worry about is avoid the blunder, and you will go wrong despite that. Because there are companies, these companies will undergo, the stock market is cyclical, and when the market crumbles, these companies will crash, and these companies will crash terribly. Simply because, if you remember, I keep giving these numbers in the context of how vulnerable small companies are. The small cap index went down by about 70-80% in 2008. And SME did not exist in any meaningful form then. Today, if it happens, I think many of these companies, going by the valuation that they command, the kind of expectation investors have, and a misplaced expectation, many of these companies will disappear, and some of these companies will, or majority of the companies will go down by 80-90%, and it won't be surprising. So be prepared for that. So there are two things to do. One is apply all the quality checks, everything, be careful about it. Second is be ready for a big accident. You should not be surprised. And with that in mind, make sure that it is not a part of your money, or the amount of money that is invested here is not something which will derail your financial plan altogether. Make sure that you are comfortable with losing that kind of money.
Okay, but considering the fact that an investor would have earned this kind of return over the past 10 years, what are the alternatives if one decides not to invest here? What are the alternatives, the high growth alternative available?
The small cap funds and maybe the micro cap funds. There are a few micro cap index funds, and I think they're very much around the vicinity. They're little bigger than the the SME index constituents, and they're much smaller than the small cap constituents. So you will be able to, and those are very well diversified portfolio, and that is available in the index fund format. So you can invest your 5,000 rupees, 10,000 rupees in those funds, and you'll be able to ride it. And those are very well diverse, because that micro cap index is made up of 250 companies. So assuming that 50 of those 250 companies will die, you'll still have 200 which will do well, which will survive, of which 50 of them become blockbuster. That will more than compensate for the 50 which will die. So you are basically taking a prudent view of the growth on the small companies, and factoring in the vulnerability of investing in a tiny company.
Okay.
So micro cap index fund.
Okay. Well, that's all about SME IPOs. Now we have a viewer's question. Virendra Gupta says, I need 12% returns from equity and minimum volatility. So which one is better to invest in, multi-asset funds or equity ETFs?
I guess he's referring to Sensex or Nifty ETF, because they are big ones, and that is what is being referred as ETF in India today. They are popular and big. One is to really understand what is multi-asset fund. Here is multi-asset fund. They invest in equity, they invest in debt, and they invest in precious metal, gold and silver now. I've been historically saying that, don't invest in a multi-asset fund because it also has gold, and one should keep away from gold as a long-term investment. But I have changed my mind simply because, gold is proving to be, for a particular reason, it is proving to be a very valuable store of value and also appreciating asset. Gold and silver is also adding a stability to the portfolio, which is his requirement. 12% or not is something very hard to guess. Over the next 10 years, given that it is substantially equity, nominally into fixed income, and also combined with gold, it is likely to beat fixed income return by a modest margin or a handsome margin. And it will beat inflation. So it's a good choice, and more so for stability. Because if you're looking at ETF, it will have the volatility. It will actually crumble when the market falls, because that is the market. So if you want good return with stability, multi-asset fund could be a good choice today. And with 10-year time frame, I think, it's very hard to guess what percent return that you will get. But I'm very confident that, if things turn out to be just as reasonable as the past 10, 12 years has been, 12% return is a very modest, is a reasonable expectation than a very exaggerated one.
All right then, hope that answers your question. That's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.